and 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. And thank you for joining me in my podcast. Hi, I'm Phil Grande, philsgang.com. Okay, a few things I thought we'd talk about today is, again, the market. What is going on in the market? It just, is not making any sense. And why is it that the six most important sectors, that 1.3 trillion a day is traded around that market, and about 65 million retail traders, are part of that, of course. They lose 85% of the time because they don't understand what yields are doing. Yields are the truth serum. We have what we call a 40-year rule that they don't know about. Yields are down, tech goes up. Yields up, tech goes down. The majority of the money, the 1.3 trillion, goes to tech. That's where everybody runs to tech. And about 45%. That's incredible. All the other sectors, about 2%, 3%, 4%, that's it. Can you imagine? So there's a lot of play with tech. But unless you follow yields, you're going to continue to be losing. Just like the 65 million people. And talking about people, I also want to talk about what's going on with this economy, because it affects the stock market, very much so, especially the workers. And our economy, as much as everybody's saying it's wonderful, it's not. We're not growing. Our growth is not coming from full-time workers. That's a real problem. And the Fed, the new chairperson, he needs to raise the rates immediately. And they've had 5 meetings now where they kept the rate between 3.5 and 3.7%. That's ridiculous. I mean, inflation is terrible. I don't know what to tell you. Every time you go to the grocery store, we all go through that, or even gasoline even still high. And boy, he's got to get the president's got to get this war over quick, or he's going to lose the midterm elections. Because, it's a shame that people don't understand what he's doing, that once those nutty people get an atomic bomb, I mean, it's over. They're going to be throwing those atomic bombs everywhere, giving one to Cuba. I mean, it's going to be unbelievable. But you got to back him in this, whether you like him or not. And the Democrats, same thing. Whether you like them or not, you got to back them. Because one thing we don't need for our kids and grandkids is the threat of nuclear weapons. I don't want to get off the path, but what's going on with the war right now hopefully creates some from part-time jobs to full-time jobs, because we got to grow our economy. Our growth has to come from full-time. And this war should give us more full-time workers, I would think. And it's destroying our economy, the full-time people. So the Fed, as I said, have not raised the Fed rate one bit in 5 minutes. That's insane. That's nuts. They're not fighting inflation. And I get it. Trump doesn't want a rate hike before the midterms. I understand what he's doing. And I know when you do a rate cut of 25 basis points, it doesn't sound like much. That's nothing. Really? You don't think so? 25 basis points is not. Let me tell you what's worse than 25 basis points. It's not the 25 basis points. And it is a lot. It's not nothing. But even if you thought it was nothing, the consequences, the emotion behind that jump is what's the killer. It's the emotion, it's the fear of what's coming. This is where people stop spending. This is where people stop spending. So it's not just the 25 basis point, it's the emotion that's thrown off. So our growth, as I said, is happening in part-time. 22, almost 23 million people actually are working part-time. And only 48% work on an average day. 48%. And then you got the full-time workers. We have 10 years ago, we had 10 years ago, and the part-time, was it 20 million? And today we got 23 million. And, oh, by the way, excuse me, the full-time workers, 70% work on an average day, and the part-time, 48% work on an average day. 10 years ago, we had 20 million. Today we got 23 million. That's a giant red flag. When you have that kind of growth. In other words, when an economy shifts from full-time to part-time, it identifies clearly. It's a red flag. It identifies to employers that they're nervous. I mean, that they're getting real nervous. And they start, again, laying off. Consumers, again, are stretched. And it also identifies that the labor market is losing its backbone. In other words, the small businesses is the backbone of our country, of our labor market. And the small businesses are the ones that are getting hit hard. And their people are going it used to go from full-time to part-time to no time. Now it's going from full-time to no time, and no, I don't have any part-time jobs, thank you, I'm sorry. Over 10 years, full-time workers increased by just 10 million. Are you nuts? 10 years? 10 million people got full-time work? What are you, crazy? That's 10 years. So 10 years ago, America, we had about 121 million full-time workers. We only have about 129 million now. That's a 7% increase? What are you, nuts? So we're getting absolutely no growth from the full-time worker, none at all. The emotion is severe. As I said, first thing, the employers, they start cutting the full-time to part-time, and right now you're going directly from full-time to no time. And again, the proof is that people who want full-time work they can only find part-time. And part-time jumped from 4.47 million to 4.68 million every year over year. That's insane. So we have a part-time workforce. So, and this is really severe because it sends out a real negative. The emotion is very negative because if you can't find a full-time job and you're part-time, you stop spending. When you stop spending, our production goes down. When our production goes down, we're screwed. We're screwed. And also another thing, when employers start cutting full-time to part-time, believe it or not, what happens is when people don't buy as much and things get worse, the banks start raising rates because they're trying to pick up some of their losses. So when people are going from full-time to part-time, they lose their job, or they're just from full-time to part-time. Let's say they didn't lose their job. They don't spend. They can't pay their credit cards on time. They can't pay their car payment on time. And so the banks, to make up from those losses, start raising rates. So we are in a bad situation right now, and nobody ever talks about the situation we're in with workers. All we hear is the economy's doing terrific. It's not. Credit cards, auto loans, business loans, adjustable rate mortgages, all are going up higher, and they're not raising rates. That's a killer. That's a killer. And everything is slowing down. So the Fed, again, is no longer debating rate cuts. They're arguing, okay, when do we hike? And they can't get that together. So, and they're trying to give us to say that inflation is dead. Inflation's not dead, not at all. So they got to do something. And as far as the market, it spills over into the stock market. The stock market, since June, 5 of the 6 major sectors have been rolling over. That reflects what I was just talking about, the economy, the lack of full-time jobs. We have no growth. So 5 of 6 major sectors, and remember, there's only 6 sectors that you really want to pay attention to when you're trading. Just 6, because that's where all the money goes. One of the 6, 48% of the money goes there. That's right. So again, every pre-market and throughout the entire day, institutional money, that's the smart money. That's T. Rowe Price and BlackRock and all the 6 biggest managers. All day long, all they do is watch the yields. They watch the yields. That's why they never lose money when they're trading. And that's why 65 million retail traders lose money every day, because they don't follow the yields. A good example is they follow the noise coming from Wall Street. And today it was interesting. They came out and they're talking about how great the stock market's doing today, right? They're talking about tech, and it's not true at all. And what they use for a story, they always have to put a story together. And what they're doing is putting the story together that the tech stocks, when they're rallying, because tech stocks, when you look at a tech stock or buy a tech stock, it's duration, okay? The duration is long, and the profits are way out in advance, way out forward. And so today, Wall Street was creating a story that the great thing about tech stocks today is that, they're counting those profits out in the future. Now they're counting those profits here today, and that's why the market's going up. And they point to these stocks. I mean, this is stupid. They point to these stocks. For example, if you look at some of these stocks that they're driving, they're trying to drive up. Let me give a couple here to you. It's insane. Let's take, for example, Microsoft. They had a big gap up because of earnings, okay? Big gap up because of earnings. And you got everybody chasing this now because they got this story about this is a long duration stock, and the profits they're making in the future, okay, are now they're clawing it back to today. And you got everybody chasing these stocks, and you got this big gap up. And if you got into Microsoft at the right time, like we did, we got it right in the sweet spot, okay? We got in and bought it right at the perfect time. It's called the 30% purchase. Now, as you purchase on a chart where it says 30%, very, very beginning, you start out with small shares, and then what happened is the stock, when we got in, it was around about $395. Today it's $488. But the point is that we had it's a 23% gain, but when they came out with the earnings, before any earnings, you always have to reduce your position way back because they can go the other way against you. Then when it comes out, with the earnings, and they good earnings, then you could add to your position again. But the point is they're using this story of duration, and then look at Google. Now today they're talking about what a big performer Google. Google's not a big performer. Yeah, it went up, but it's in a downtrend. And Amazon, another one they're creating a story with. Okay, remember Amazon had earnings and that went up big, and everybody's chasing it. But the problem is there's no follow through on these stocks. They're trying to create this story to hold these stocks up. And the problem is the institutions aren't buying these stocks. It's machines that are buying these stocks. So you got to know what you're doing. You got to know what yields are doing. And as long as you know what yields are doing and you know how to sell short as well as buy stocks, then you'll be fine. But if all you do is buy and you have no understanding of yields, you're going to continue to be part of the 65 million people who lose every day in the stock market for 35 years. It's crazy. So we can help you. We can help you with that, all right? You got to learn how to short, and you got to learn how to follow the yields, or you're just going to keep repeating your losses year over year over year over year. And it's sad because the stock market's the only place today that you can really make money and keep up with inflation. Okay, I will see you on the charts. Thank you for joining my podcast. Hope you enjoyed it. philsgang.com. Check us out.
Are you nuts?